you can watch as they're writing Dodd-Frank, which is the big American piece of regulation following the '08 financial crisis that um, requires more strict capital controls, that banks hold more equity against riskier assets based on the level of risk in those assets. And but you can see it just gets watered down as the lobbyists get their mitts on it.
Well, that's another thing with Silicon Valley Bank, right?
Mhm.
Didn't they lobby during
Totally.
the Trump era to have some of those regulations pulled back?
Yeah. Yeah. So
Do you think that would have changed anything? I've heard pros and cons on both
I don't
sides.
really know whether it would have changed anything. I mean, certainly regulators have fallen asleep at the wheel. I mean, these things are not uh they're not new. I mean, we've had major banking panics. We had the savings and loan crisis in the 1980s. We had the failure of a couple of big hedge funds that caused a massive banking panic. So, failure of long-term capital management. The '08 financial crisis. All of these things, regulators should have been able to catch. What we've done really kind of in this era, this deregulatory era that goes back to Carter, but really comes to full fruition under Reagan, but then is totally bipartisan. I mean, Clinton did more to deregulate the financial sector than probably any president, in the last 30 years. So it's totally bipartisan because
They're all getting paid.
they're all getting paid, and there is this underlying ideology that, these people are really smart. They know what they're doing. Let's, let them, let them figure it out. Right. And um, the Silicon Valley Bank example, yeah, they're lobbying to try to prevent regulation under Dodd-Frank because they're kind of, I mean, it's funny. They're the sixth. I think they were the 16th largest bank in the United States when they failed, but they argued that they're not so big that they need massive regulatory oversight. And they send lobbyists to, prevent any sort of regulation of them and other banks that are of similar size. The big, what are now called GSIBs, globally systemically important banks, of which we just had another one fail or be bought up in Switzerland.
Credit Suisse.
Credit Suisse got bought up by UBS in a shotgun marriage. Those banks are regulated under the Dodd-Frank rules because they're deemed too important, too big to fail, right? With Silicon Valley Bank, they were not susceptible to that type of regulation. But the Fed should still, I mean, you have banks have to adhere to a lot of regulation. There's a whole bunch of regulation in place to allow banks to operate, even, your local credit unions. But regulators need to be doing their homework and seeing, look, Silicon Valley Bank had major interest rate risk. And I mean, it's almost banking 101 that if you're holding a bunch of treasury bonds on the asset side of your balance sheet and the Fed's going to start raising interest rates, you've got a bunch of risk in that situation, right? And the regulator should have definitely stepped in and said, look, you've got to hedge against this risk. You've got to start selling some of these bonds before interest rates go up as much as they were. And we've known that interest rates were going to go up. The Fed has been announcing it.
It's not been a shock.
Yeah. And so, I mean, it's like, I would have happily run Silicon Valley Bank as poorly as it was run for the amount of money that the executives got compensated, right? I mean, they just did a terrible job. The executives did, and the regulators also did a terrible